Very good morning to you all. This time it's a Sunday morning for a Quality Cafe session. We welcome you all, and we do understand that you have taken out your time on Sunday, but we understand that you love this session. The feedback has been very good. And with this, before I welcome the chairman, I would like to tell you that's the 11th session, which is on the importance and identifying and assessing the risk of material misstatements and determining materiality. So with this, I ask the chairman, the convener CAQ, C. Vishal Doshi, to please take the session forward. Sir.
Yeah, thank you, Ruchika. A very, very good morning. I would say a very, very good Sunday morning to all our participants who have joined this 11th Quality Cafe session on a very important aspect with respect to the risk of material misstatement. Well, friends, like Ruchika, I would also like to thank you. Actually, we normally do it on a Saturday morning, but since yesterday at All India level, we had the convocation where we convocated almost 15,000 new members, the chartered account, I would say the students who became chartered accountants. We had to reschedule this to a Sunday morning. And along with the participants, I would also like to thank our panelists, Bhavani ma'am and Aditya ji, who have spared their Sunday morning for discussion on a very, very important topic with respect to the importance of identifying and assessing the risk of material misstatements and determining materiality. And typically, the standards on audit which deal with the material misstatement, we can say, are the SA 315, which is the identifying and assessing the risk of material statement through understanding the entity and its environment, and SA 320, that is materiality in planning and performing an audit. The objective of an auditor is to obtain a reasonable assurance about whether the financial statements are as a whole are free from material misstatements, whether due to fraud or error. And we always, as auditors, are at times lost as to what is materiality, how to calculate materiality, because our audit opinion would depend on the quantification of the materiality. And there are different factors which are there to determine materiality. And again, materiality is a very relative term. In a normal parlance, if I say that for a person who is earning 10,000 per month, 5,000 would be a material amount. But then for a person who is earning 5 lakh rupees, maybe 5,000 loss in the stock market or something would not be material. So the same amount, 5,000, would be material in some cases and immaterial in other cases. And therefore, it becomes very important that as an auditor, determination of materiality is, I would say, a matter of professional judgment. And that is also affected by, as auditors, how we perceive the financial information need of the users and the stakeholders with respect to the financial statements. The concept of materiality, I would say, is applied by the auditor both when they are planning the audit as well as performing the audit, and evaluating the effect of the identified misstatements on the audit and also of the uncorrected misstatements, and informing the opinion basis which I would say the opinion in the auditor's report would be formed. And an item of information, it may be material if its omission or misstatement can influence the economic decision of the user of the information. Materiality does not necessarily establish an amount below which the uncorrected misstatement individually or in aggregate, so in totality, will always be evaluated as immaterial. Many times, the circumstances also that are related to some misstatements may cause the auditor to evaluate them as material, even if they are below materiality. So it's a very, very judgmental, I would say, thing when we talk about materiality. So, determining materiality and the material misstatement in financial statements, they form the core of the audit. And I'm extremely, extremely happy and delighted to share that we have two very learned and experienced speakers with us today. CA Bhavani ji Balasubramaniam and CA Aditya ji S. Kumar. Both have rich, long experience in auditing. As convener of CAQ, I'm also very happy to share that on 25th, we had a council meeting, and as from the CAQ, we have released a utility. It is an Excel utility for determining and documenting the materiality, performance materiality at the engagement level, and also the impact on the auditor's opinion. So, broadly speaking, in the today's session, would be like we would have initial opening comments. I'm happy to welcome the Deputy Convener, Sri Priyaji, also to this Quality Cafe session. So we will have Sri Priyaji giving her thoughts on this topic, and also the work that we do at the CAQ. Then we would have the opening comments on the topic from the learned speakers. Then Ruchika thereafter would spend some time in explaining the Excel utility that we have released from the CAQ, and how it can be used, or I would say how to optimally use that utility. And thereafter, we would have the panel discussion where there would be a question answers from the CAQ, and also for which we invite questions from the participants so that they can be put up before the panelists and they can respond to it. So with this, once again, I welcome all of you to this 11th Quality Cafe session. And now I would request Sri Priyaji to kindly give her opening remarks.
Thank you, Vishal Bhai. To say Vishal Doshi, the very exemplary convener of the CAQ. And I will shortly tell you why I think we make a great team. To Ruchika Vachani, the secretary, who's been doing some phenomenally good work. To Madam Bhavani Balasubramaniam, who's sort of legendary as a chartered accountant in South India. There's no lady CA who would not know Mrs. Bhavani. And I think for me, she's been a personal role model, having served in a very large audit firm, and the way she just handled her personal and professional life with aplomb is remarkable. Aditya Kumar, whom I again happen to know quite well from Bangalore, and to the most wonderful ladies and gentlemen in the audience here today who are here to spend a Sunday at 11 a.m. to learn. I think here's a very, very hearty welcome to all of you. And the CAQ, which is the Center of Audit Quality, is a fairly young baby child in the context of the kind of work that ICAI does. So there was an intense need that was felt to create a separate directorate to, kind of speak about, to debate, discourse, and provide tools on audit quality, and hence the CAQ emerged. It was created in the last council term, and this term, Vishalji is the convener, and I happen to be the deputy convener. I think the first part of our creation, we just wanted to demystify things, set some ground rules, and say what needs to be done in audit quality. So the what is all there across the diverse spectrum of auditing standards. Primarily, it's your auditing standards that define audit quality, what should be. And but I thought Vishal Bhai had a pretty nice vision. He said, look, all of us know what to do. How do you get to translate it into how to do it? And that's going to be the focus of CAQ this year and in the years to come. We realized that this audit fraternity is a very, very large spectrum, very geographically dispersed. And so the potential for everybody to have a common minimum standard was becoming difficult. So I would be practicing in a far-flung place down south, where I might not have, the kind of exposure that somebody who's used to listening to other peers in the bigger city. So we said we should come up with a set of tools. And it's in that context, we released a fairly nice publication, or another toolkit, basically for bank audits. And this is the second in the series, and Chairman and I are absolutely committed to delivering more. So, and to speak about this tool itself, I must state that this was after a lot of effort that was done by a core group that was in which Bhavani ma'am and Aditya were also parts, and with extensive involvement from both the chairman and to a little extent with myself and with Ruchika. So we spent a lot of time trying to bring all that together into an Excel model. Audit is obviously done under GAAP, which is your generally accepted auditing principles, which allows you the benefit of sampling to define your own kind of shell within which you say, okay, this is what I have done. And based on what I have done, I express an opinion as true and fair or otherwise. It's in that context that this materiality determination, as Chairman had mentioned, becomes extremely important. Why? because your materiality also drives your audit risk. And what's an audit risk? An audit risk is a risk that the auditor has failed to detect a material misstatement. That's where it starts from. Or whether it's due to fraud or error. And in that context, it becomes very important for an auditor to appreciate what's material and not. So with these few words, I'd like to hand the session back to the chairman with a very, very personal. I don't intend this to be flattering, but just taken the liberty of being a bit personal here. And I've seen Vishal Bhai's commitment on this. It's been truly outstanding. And for us to actually roll up our sleeves and actually work on these models, it's very nice. Thanks, Vishal.
Thank you, Sripriyaji, and that was quite humble of you saying that you had played a very limited role in this tool. Let's be very candid that it was something that the whole team contributed, and you, Ruchika, the whole CAQ team also. And like you rightly mentioned, yes, it would be our endeavor to keep releasing such tools or templates and utilities, which becomes I would say on a ready platter to the members that they can just understand and implement that, and thereby improving the audit quality overall. So thanks, Sripriyaji. And I would now request Ruchika to kindly introduce the panelists that we have for the day, and then we would request them for their opening remarks. Over to you, Ruchika. You'll have to unmute, Ruchika.
Ruchika, should we request our panelists to come on video unless there's some?
Yes. Bhavani ji, Aditya ji, you can. Yeah, please. Yes, Ruchika.
CA Bhavani Subramaniam, she's a fellow member of the Institute of Chartered Accountants of India, having more than 4 decades of audit experience. She has extensive experience in auditing a variety of clients, including listed companies, multinationals in different industries in India and abroad. Apart from leadership roles and positions, she also holds various positions in professional bodies. I on behalf of the Center for Audit Quality, welcome you, ma'am. Mr. Aditya Kumar, he's specializing in auditing standards and other financial reporting aspects. He has undertaken statutory audits, limited review, internal audit of companies in various industries, including banks, mutual funds, insurance. To name, if I continue, the list is really long in terms of industries which he has handled. And he has also, which of course includes the subsidiaries of Fortune 500 companies. He advises on Ind AS, IFRS, multiple GAAP to Ind AS, including transition, implementation, training, and regular updates and implications. I welcome you, sir, to this Quality Cafe session. Sir, you can take this forward, sir.
Yeah, thank you, Ruchika. So I would now request Bhavani ma'am to kindly give her opening comments with respect to the assessing the risk of material misstatement in the financial statements. Over to you, ma'am.
Good morning, my dear colleagues, chartered accountant colleagues. Thanks so much, Vishalji and Sripriya, for giving me this wonderful opportunity to work with you all in the CAQ, especially on this tool which I have been first involved. Let me confess that I have been involved in preparing 7 to 8 implementation guides on auditing standards. And I have also prepared the e-learning on auditing standards, about 45 modules, but all those were very general and not pinpointedly satisfying as much as this materiality tool which I worked on. Because, it came to a practical tool to implement. Any amount of FAQs, any amount of theoretical guidance, any amount of solved case studies in an implementation guide and templates, in the Word format, don't give you the satisfaction of this one Excel. And this Excel is really excellent. And I'm so happy that members have got something on hand, and wonderful that we have a download of already 370 in a day. So we can imagine the count it's going to go to. And we can proudly say that our institute has given the guidance, and to my knowledge and understanding, I think this is one of the great specific guidances worldwide which have been released, because I have not seen this being done with so much of precision anywhere. Because the standard thing is, they will say it's left to professional judgment. So you can't really give a specific kind of guidance. Even in our practices in member firms, the guidance is not that exhaustive. We leave a lot of these things to professional judgment, and people should refer back to the theory, the resources, and the methodology. But everything in one, without anybody having to refer back to any standard, is an excellent work. And Ruchika and her team have really made it so nimble. It's such a nimble and adaptable tool. And it's something which, if members don't download, it's a personal loss to them. So with these wonderful words, auditing was something which has been there ever since Chanakya's days. Kautilya, Chanakya's times, audit started in India. The country has got this particular expertise that age old and heritage old. But we all realized, due to happenings globally, due to some happenings locally, that risk comes from not knowing what you're doing, as what Warren Buffett said. And as auditors, we were blamed. And it is our task to fix the course for the future. And this was what was felt globally, as John F. Kennedy said. And therefore, the Indian Chartered Accountants Institute, being a member of the IFAC, had to follow the IASB, had to follow these standards. The standard SA 315, the most lengthiest standard with all the complicated paragraphs and 2-3 appendices, is a mother standard which rewrote the entire auditing theory. So when we talk about assessing risk of material misstatement, the standard had changed the way we did the audit from standard procedures to tailored procedures, from information incidentally collected when you did a traditional audit to searching for information, having standard tests and levels of testing in our traditional methods to different levels of testing differentiated by risks we identified and areas of concern which we wanted to do. An account balance based audit instead was replaced by an assertion based audit to make our audits more pinpointed and more effective. And from a basic planning of selecting 4 months in a year or selecting transactions above a particular amount, we went into and were taught to do a very detailed planning at an account level and at an assertion level. And a standardized set of procedures were changed in audit to a set of efficient and effective procedures. And this has been the overall benefit and the purpose of risk assessment of material misstatements. And we have the standard 315, which concentrates on this and gives us a lot of insight into understanding of the entity and the control environment. So when we talk about assessing risks of material misstatement, it's designing and performing audit procedures to respond to the risks which we have identified and assessed. And therefore, by tackling those, we try and reduce the possibility of errors, that is, the level of misstatements which are material, and therefore able to issue an opinion which is well supported by the audit work we do. In terms of audit risk, it contains 2 elements. And the risk of financial statements and misstatements thereof would be that which are arising out of a lower understanding of what could go wrong in the financial statements, and also the risk that the auditor will not be able to detect the level of misstatements. To reduce this to an acceptable level, the auditor has to assess the risk of material misstatements and also limit the detection risk by planning a set of procedures which would address the possible pitfalls in the preparation of the financial statements or the audit work. The risk assessment process, therefore, has the following steps: planning, performing client acceptance and continuance procedures, then the overall engagement, and as part of this planning process, performing risk assessment procedures to understand the business and identify the inherent and control risks. All of us know that overall audit risk comprises of inherent control and substantive risks. And therefore, trying to pick these upfront is the speciality of this standard, because it lays out the step-by-step methodology for us to go about doing this assessment. Identifying risks of material misstatement, not only risks, significant risks which would require significant audit consideration, including fraud risks, are to be identified and assessed as part of our planning process. Friends, the audit plan, therefore, is so much in detail, and a ballpark is said that about 60% of our time on the audit is spent on planning and on risk assessment. Because at the end of this process, you would be very specific on what to do, how much to do, and when to do. So therefore, making informed assessment of risk of material misstatements, both at the financial level, at an overall level of what is the risk, which is there that the financial statements could be materially misstated, or whether specific account balances could be materially misstated, including disclosures, is what this standard addresses. There are various other risk assessment procedures, which would be other than inquiry by management, analytical procedures, and observation and inspection, which are the three basic standard procedures. There are other procedures like getting information about pre-engagement activities, experience, understanding, and handover of those kind of lived experiences on the audit by previous people, understanding the organization structure, including the revised structure, past misstatements, and inquiries with not only the people who are directly in the management, but other stakeholders such as legal people, internal auditors, other experts who have been involved with the client would be useful. Reviewing information from external sources is also part of the risk assessment procedures to keep our eyes and ears open on what is going on in the media, what is being reported upon by the regulators, and so on. And having discussion with those people charged with governance to get a hang of their understanding of the risks facing the company. When we talk about assessment of risk, our focus should be on external factors, on the nature of the entity, the objectives and strategies of the entity, and the way they measure and review financial performance. External factors, all of us are aware that it could be due to competitors, the risks due to that, regulations, specific risks related to the industry, the legal and the political environment. Friends, I draw your attention to the guidance on core during the COVID time, which was released by the Audit and Assurance Board and the Accounting Standards Board, which very clearly led us through those 2 years and even now for the after effects of those on the financial statements. That is a wonderful accumulation of the risks which could be addressed, being so timely at that environment when people needed all the guidance. In terms of industry risks, it could be an industry which is cyclical, seasonal product which is facing technological challenges. It could be long-term contracts. In terms of understanding the entity, one needs to understand whether the entity is a standalone startup, well mature, whether it's part of an alliance, a JV, is it an investment holding industry, are there planned divestitures, and so on. Because the concentration has to be on the fair values, and therefore these developments are important to know. There could be related party transactions, there could be various unusual or significant transactions which would require disclosure, and there could be material matters which need to be discussed at length and then addressed during the audit. So these are some of the aspects which we need to think of as part of understanding the entity. And in terms of business risks, one needs to look at various aspects from the overall economy. The director's report in listed companies is a wonderful culmination, including the MD&A and also the ERM framework, for us to pick all the risks which would affect the industry as well as the entity as a start point to understand the inherent and the business risks. We can go on in terms of understanding these things for a long time, but the standard is very lengthy, and we need to address the various aspects within these 15 minutes. Understanding fraud risks. We all know the basics of fraud risks. It could be misappropriation of assets or manipulation of financial statements. But what is important in the standard is that when we do a risk assessment of an account balance, a disclosure, or when we challenge whether something could go wrong at the assertion level, we will also have to assess the risk of fraud. So it is not a separate process, but it is a process linked to every risk which is identified, including the inherent and the entity level risks. In terms of audit risk components, as I told you earlier, inherent risk, fraud risk, control risk, combined risk, and detection risk are the various aspects of the shades of what could go wrong when we identify issues, red flags, when we come across things which don't look right. For instance, if we look at the financials and we have a history of a 10% gross margin, and for some reason the sales and the cost of sales don't reflect that 10%, you would automatically red flag it. What was in the past as a kind of set of matters which don't strike according to our common auditing knowledge, common sense, and past experience are those which are codified and much more refined to be defined as risks of a possible set of material mistakes. So to just tell you that it is not a process which is changed overall, but it is a process which has been recodified. In my days, identifying risks was not a technique when I started auditing. And we would all be taken by surprise when the partner comes in and says, there is this new division, have you seen this? Or he or she would come up with some aspect which we would not have even seen. And you will sit overnight and do all the checking for that because you're facing a board meeting in 48 hours. Today, the process is partner involvement has to be upfront, and the planning and significant judgments are left to the senior people in the audit team. And therefore, I'm mentioning this because the planning forms and the risk assessment techniques cannot be delegated to the lower level people. In terms of the risk assessment process, client acceptance and client continuance could give you some factors relating to risks in relation to the entity. Planning the engagement by performing a risk assessment, trying to understand what changes have happened in the business, how is the control environment, the 3 A's of management. Overall, does the control environment support a risk assessment process and a risk management framework? Therefore, understanding the accounting process in terms of the kind of automations, whether there are enough controls over financial reporting, and determining what is material to these financial statements. All these steps should result in you being able to answer the question, are there any risks identified in this 5-step process? If we have identified some red flags or risks, then it is important to culminate them in a separate list of the risks which we have identified. And in terms of any inquiries we've done with management, and when we do an observation and some analytical procedures at the planning stage, it's important not to confuse ourselves with the detailed procedures and the detailed observations and inspections which we do when we do an inventory count. This is basically a set of simple steps to confirm our understanding and reconfirm our understanding. Similarly, in terms of control systems and processes, what we used to do as part of planning is a simple walkthrough of 1 or 2 transactions to understand the process and make sure that the controls and systems are working properly. Or if there are any pitfalls, how are we going to address them? So at the end of this risk assessment process, we should have a set of risks which we have identified and then take a call as to how we are going to further analyze these risks and pinpoint them. So when we talk about risks, it could be, in short, risks arising out of engagements, risks due to information which was available at the planning stage, risks which arise out of us identifying some transactions. It could be risks relating to prior experience. It could be due to the accounting process. It could be some unusual or significant transactions. It could be estimates wherein there are period end adjustments. There are subjectivities in the kind of estimates which are made. There could be over the top adjustments towards the end when the preparation of financial statements, which could reflect a management override or a compulsion to meet a particular covenant. So these are items which we'll have to pick up during the process by probably matching the draft financials with the final financials given to us for it. In terms of documentation, we will have to do a documentation of all this process in great detail. And finally, the documentation of the accumulated risks which we have identified, and then be able to pinpoint them to which are the account balances which are subject to risk, and within the account balances, which are the assertions which are subject to risk. This amount of sifting and fine-tuning of the risks is essential to help us to do an effective audit and an efficient audit. It's easy to say the entire account balance has a risk, but then we would be doing unnecessary scope of work. If it is possible to narrow it down to which location has a problem, which sub-account level has a problem. Of the sub-account level, are we questioning the existence? Are we questioning the recurrence? Are we questioning the recording? And so on and so forth, relating it to the basic assertions would help us do a very efficient job of the risk assessment process. In terms of our final documentation on this, the key documentation relating to the risks, the account balances, those assertions which we believe are affected, and above all, the ones which are material and significant in our understanding needs to be documented clearly. Information needed on significant matters, planned procedures, reasons for significant changes, and an identification of a materiality level, which is at the planning stage. So that's in short about the risk assessment standard on assessing risks of material mistakes. Thank you, Vishal.
Yeah, thank you, ma'am. I think that gave quite a insight into the standard and also with respect to the assessing the risk of material misstatement in the financial statements. And I think one important aspect with respect to audit, what you mentioned, and if I can summarize, is failing to plan is planning to fail. I think that holds very, very good, that proverb for the audits. And I think materiality is amongst the first things that we need to have on hand before we start the audit. So with this, we come to Aditya ji. And Aditya ji, I would like you to share your opening comments with respect to relevance of materiality for audit engagement, including, especially the small engagements, because we have a lot of small and medium enterprises which are subject to audit in India, and for which a lot of our practice units also engage into it. And what is the relevance and importance of materiality overall, and especially with respect to the SMEs? Over to you, sir.
So, good morning to all. And am I audible, sir?
Yes, sir, you are.
Okay. Okay. Thank you so much for the introduction, and thank you all the members for attending this webinar. As far as relevance of materiality is concerned for audit engagements, I go back to the fundamental concept of why we are giving the audit report, and the objective of the audit report is to report on the true and fair view of the financial statements. And in the context, in Indian context, we also report certain aspects in CARO, certain aspects in 143(3) of the Companies Act, and also report on the internal financial controls and their operating effectiveness. So all these are covered under the audit report. But to achieve the objective of reporting true and fair view, there are various considerations that are taken, including, as Bhavani Madam mentioned elaborately, on the risk assessment procedures, understanding the client and their business environment, knowing the laws and regulations applicable, assessing the going concern, using the work of an internal auditor or a management expert, and so many other aspects going to the auditing, including doing analytical procedures and substantive testing procedures to check the balances of various accounts and their assertions on a sample basis. Now, to validate all these assertions in the financial statement, auditor does vouching, verification, observation, inquiries, etc. And these results are then evaluated, possibly using some statistical techniques also. In the course of all these procedures, the auditor is bound to observe certain errors in the financial statement, and the decision is up to the auditor to make it to ensure that these errors do not cross that Lakshman Rekha, what I would call it as. And if it crosses that Lakshman Rekha, I would say the financial statements are misstated. And for me, this is the golden rules that all the errors accumulated and which crosses that borderline, I think that's the red flag and the alarm bell should start ringing. So I guess the auditor in these cases has to evaluate whether or not the financial statements show a true and fair view. And the term materiality refers to the mechanism of selecting the number or selecting the benchmark that can be used to be reasonably assured that if the audit doesn't notice any misstatement in accounting, then it won't significantly misguide the users of the financial statements. So any transaction can be considered material if its omission or misstatement or can even obscure the financial information could potentially influence the decision of the shareholders. From the materiality standpoint, why is this important and how do we calculate it? What factors has to be taken? The auditor has various tools, and I would prefer to keep this in two buckets. There are certain financial factors. It could be expenditure, it could be the net assets, or a combination of these factors which could contribute to the decision making of the materiality levels. And there are other aspects, like whether the company is in a stage of started company, is it a start? That auditors typically have to consider when arriving at that particular benchmark or the golden number beyond which they need to consider that financial statements could be materially misstated. I also understand about the audit risk that needs to be dealt with here, because there's an inverse relationship between the materiality and the level of audit risk. That is, the higher the materiality level, I feel the lower the audit risk and the vice versa. And auditors would take into account this inverse relationship between materiality and audit risk in determining their nature, timing, and extent of the audit procedures. And for example, if the audit is planned prior to the period end, you could typically anticipate what could be the financial position or the performance. And if it does not come out the way it is anticipated, then yes, the red flags would be on as to what could have gone wrong in these areas. In the relationship with the audit report, typically as an auditor, we also have a paragraph written in the audit report on how the auditor considers materiality and what would constitute material misstatement in the financial statement. And if there are certain errors which could really go on to the financial statement and make it materially misstated, we typically ask the management to rectify it. And if that rectification is done, there's nothing much to do. But if there is a disagreement and if the auditor opines that, yes, the financial statement does not show a true and fair view, this materiality factor becomes very, very important when the auditor has to modify their opinion. Now, coming to the topic of for small and medium enterprises or smaller entities, where they also contribute very large to the Indian economy. Now, from the financial statements perspective, if you see, there are a lot of guidance given by ICI, typically on the preparation of financial statements for non-corporate entities. There is level 1, 2, and 3, 4 classifications where the accounting standards applicability is also considered. So level 2 and 3, 4 companies may not have all accounting standards applicable with the same rigor as for a level 1 company. Then we also have certain implementation guidance for audit of smaller entities that also needs to be considered. The factors that typically get into the SMEs or the smaller entity would be mostly it is either promoter or family driven. The control will be in the very few hands. There is lesser documentation in terms of the risk assessment. And if you look at the cost versus benefit analysis, it tends to be that for these entities to have a very formal documentation the way it is required to be, it tends to be a bit costlier for them. So this is one of the factors. Second, if you look at the segregation of duties level, Unlike large organizations where it is documented, it's all configured in ERP, for smaller entities, it may not be so. So there is that audit risk that gets involved all in these kind of environment. At the same time, the risk assessment of the auditor with regard to smaller and medium enterprises also play a role. So does it mean that we can say that, okay, let's not consider materiality? No, we cannot say that. Can we consider that all these assignments are typically very risky? I would not subscribe to that idea as well. So you need to have a sort of balance between how much to do for risk assessment, what factors needs to be considered, vis-a-vis how do we set the materiality level so that the auditor is not doing 100%. I mean, all the audits are done on a sample basis. So what would be the right amount of sampling technique and what would be the right amount of audit procedures that the auditor would have to carry out, again, is a matter of professional judgment. And that is why the CAQ has come out with this tool to aid the auditors, to help them to make that decision making. Across the world, I'm just taking an example also. There are certain countries where the audit report also includes the materiality level and how that is being used in preparation of the audit report. We have not come to that stage as yet, but I'm just highlighting that the importance of materiality is so much that your entire audit report and audit conclusion depends on that Lakshman Rekha that I call, that if it crosses, your opinion changes, and if it is well within the limits, yes, the auditor is comfortable giving a conclusion, again depending on various factors. So this is what I feel is the relevance of materiality for audit engagement, including for small engagements. Over to Ruchika.
Yeah, thank you, Aditya ji, for that insights into the relevance of materiality. I would now request Ruchika to kindly, I would say, give a demo of the Excel utility that the CAQ has released with respect to materiality, going through each and every aspect and how that can be optimally used by the auditing fraternity, and also can be helpful in their documentation requirement with respect to materiality. And after that, to kindly start the panel discussion and to moderate the same. Over to you, Ruchika.
So, well, all can see the screen.
Yes, it's visible.
Okay, sir. Thank you. So the first question which I'll answer for the participants, where do we find this utility? So you'll find this utility at the ICI page. We have a specific page for Center for Audit Quality. It comes under What's New section. So what you typically need to do is to just fill few information about yourself, your membership number, your name, your mail ID, and then you submit. And after submitting, you can have a download of the utility. Before you start using it, I would request you to download this on your system and then start using it. So it's divided into various sheets. So when first sheets talks about the guidance, what we have given the guidance is from SA.
Can you just increase the screen size? Can you view Zoom to 100? Alt view Zoom. Just go to Alt VZ. Ruchika, go to the first sheet, just the size of the font, that's all. Or you can just increase the font size, either which one. Just go to guidance, yeah. Just press Alt. Go to the sheet and yeah, just press Alt V Z.
Yeah.
Oh, okay. Okay, fine. It's a protected sheet, is it? Okay. But can you just go to the, yeah, it's okay. You can.
So sorry. So guidance is basically driven from SA 320. It gives the need, what is the time when we should determine materiality, which is again at the planning, and as the audit progresses, we can revise. Then it talks about performance materiality, the documentation aspect, and how materiality affects the auditor's report. It also lays down the steps which one should follow while using the utility which we have prepared. So I would just request the members to please go through this before you get on to actually calculating materiality at this sheet. So I'll just take you through this sheet, which says you enter the name of the entity here. It asks you for the financial year for which you are documenting the materiality, calculating the materiality, sorry. It gives you the option to choose between the planning and the revised stage for arriving at the materiality. So it goes as a drop down here. It asks you for the type of engagement. We have given few drop down: statutory audit, limited review, and special purpose under this. Prepared by, reviewed by, it's something which is required at the engagement level. The authority, the level who has prepared, typically the engagement partner, the management, the engagement lead, and reviewed by, and the date. Now, for arriving at the materiality, we have certain factors which helps us to understand the risk for that engagement before we take the materiality benchmark. So how do we assess this risk? It's basically divided into, it is based upon certain parameters. We have listed 27, of which if we see 27th number is any other to take care of the needs which may not be there in 26 above. So going by the type of engagement we choose, suppose if we say it's a new engagement and I classify this parameter as a high risk here. So my weight attached to it, I can align as from 8 to 10. So as in what I select, typically the level of risk here, my weightage also changes accordingly. For high risk, it is 8 to 10. But if I say it's a medium risk for me, then the drop down will show 4, 5, 6, 7. Same would go for low risk. If I select low risk here, then I'll have to choose between 1, 2, and 3. Once I choose my level of risk under these 27 parameters, here, this is linked to now my classification of low, medium, and high risk as an individual, as a firm, may also be subjective. It's again a professional judgment involved. So what we have done is we have given you yourself to decide your risk parameters. For example, the total low risk coming or a medium risk, for example, in this engagement, I can classify that anything, up to 30% or 15% is low for me. Medium would be 15 to 75 for me. And so this can accordingly change. So if I change this to 30, saying it's 30% for me here, so my from changes 30% here, and my high can also be changed or lowered. Suppose I take 70 here, so it's 70. And accordingly, my overall risk here, which is 21%, suppose for this engagement, comes to low risk for me. It's an overall risk assessment for that engagement, which I arrive as 21%. Depending upon what factors, how have I judged each of the factors, categorize them as low, medium, or high. In addition to these three, we have also given an option for NA, because there would be certain factors which may not be applicable to the engagement you are trying to calculate the materiality for. So once we do an overall risk assessment for the engagement and classify the engagement as low risk or high, of course, the overall risk assessment cannot be NA. It has to be low, medium, or high. Then what we need to do is we have to select the type of entity. Now, typically, if I say my engagement is a profit-oriented engagement, then what I need to select, my benchmark comes profit before tax or normalized. For example, if we now go to not for profit, then the benchmark says select. Now, what do I have to select? Because for not-for-profit, I can choose a different benchmark. The different benchmark would be total revenue or total expense, depending upon what I want to go ahead with. So if I say total expense, then total expense would come as a benchmark here. Similarly, for a debt finance type of an engagement, it will be net asset value here. For an entity which is executing a public utility program, it is total cost, net cost, custody of assets. So the member who is using this utility has a choice to choose either of these benchmarks to decide upon the materiality. So now if we take a typical example of a profit oriented, in which we consider profit before tax or normalized or adjusted profit, and we enter the amount here. This is a flexible number. Whatever is my profit before tax normalized, I will put that number here. So of course I can change this number. Against this amount, against this profit, I have to choose a percentage range for materiality. Now, we have given a suggestive range as to if we categorize the risk of material misstatement high, medium, or low as above, then we have given these ranges. But of course, this percentage determined is upon me. If I want to choose, I still want to choose a lower level of see, my risk assessment, for example, has been low, and I can go for a higher materiality level, but I may still choose to go for a lower materiality level, then I can do that here. So while this is only a suggestive range, for determination, we have given the flexibility to the user to modify the percentage accordingly. You can go with the suggestive range as per the guidance, or you may choose and document the rationale for selecting that percentage. If you are not selecting the suggested, or if you're not selecting the range in that selective, then you should document the reason that why you have taken up that percentage. This will help you whenever there is an EQCR, whenever there is a review by an authority, any other regulator, how we have considered the materiality. It will help me in explaining why did I choose the percentage which I want to. And suppose in this case, we have taken 3%. So my overall materiality comes to this number. In addition to this, we have also given the performance materiality determination, which is in the range of 50 to 90%, suggestive range of 50 to 90% of the original. So you can, this is again open, you can fill in any number and you can arrive at performance materiality. The third calculation is with respect to clearly trivial threshold, which we have defined to be 0 to 5%. Upon you to choose a number and apply that range and take out the number which you think would be clearly trivial for you not to consider during the audit. Here we have given references to the notes you may give above. This utility is for calculating the materiality at the engagement level. We have not gone to class of transactions or individual account levels, though one may do that risk assessment for the engagement, for the different account balances at their level and go for the materiality in those account balances or heads. So this is with respect to calculating the materiality in this sheet. If we go to the next sheet, which is on the risk assess, on the risk of material misstatements, or which we have found during the audit. In total, when we compare it to the materiality determined, we say what has been the effect of the total uncorrected misstatements on the opinion which the auditor would be giving. So, in case of material misstatements, uncorrected misstatements being higher, one has to go for a modified opinion. So this sheet will help us taking through the requirement of SF 450, where we map the impact of the risk materiality on our opinion. While, this is something which is really subjective in the sense as is a lot of judgment, professional judgment, which is required in terms of categorizing a parameter as low risk, as what we have been doing. But now we can do it as a utility in this. If as what I said, if there is any parameter which you do not find place, that can be taken under this any other section. I'm just hopeful that, when we're talking about materiality in terms of engagements, the auditors, the new auditors, they actually understand. In fact, the existing ones, it would be useful for them to calculate and document, because you can have a printout of this and document as a part of the documentation requirements for the essays also. And I hope that the members will find it useful, and we are open to accepting any feedback, positive or negative, so that whatever utilities the Center for Audit Quality has issued, will be issued in future, we take the feedback and we try to make it more user-friendly. It is not confusing. We want to keep it really easy so that we all understand and use it to the best extent. With this, I would take the session towards a panel discussion now. Thank you so much. And as I said, this is available on the ICAI page of the Center for Audit Quality page of the Institute of Chartered Accountants of India, from which you can download and start using it. Thank you so much. With this, I take the session forward to the panel discussion. Ma'am, should I take the questions, ma'am?
Yeah, please do.
Yeah. You wanted to add something, ma'am? No.
No, I can add it towards the end as well. I think the template that you see is perfectly aligned to the standard. It provides you that flexibility to incorporate your own parameters. So it logically flows down from risk to materiality, and the standard speaks about whether the entity is profit oriented. Now, why is that important? Because that forms the benchmark for determining your materiality. If it's a profit oriented entity, then obviously profit becomes the benchmark, because that is what can get materially misstated and finally. So if it's a not for profit, then it's an expense or a revenue parameter that becomes the base for materiality. So what Ruchika has done is we've tried to condense the entire standard and put it into a workable format, allowing enough scope and space for professional judgment. With this, you can proceed.
Can I add something, Priya?
Sure.
Okay. For the attention of the members, normally when we present our materiality for any kind of reviews, international or our own peer reviews, there is a lot of questioning on how you decided this benchmark, how did you decide the factors, and so on. This would be a speaking response in future to our judgment. And to give you another comfort, regulators will be very happy with this sheet, because the way they are moving now towards their internal audit scoring of risks, whether it is banks or whether it is NBFCs, and all their scorings have been based on giving weightages for risk factors. So this would be more acceptable to regulators than any other format we have had so far. Priya, wonderful. Priya, your passion to always give some tools and templates for people, I think this is the crowning one of all, I would say.
Chairman, actually, so the idea was his, so we just really.
Of course, Vishal, with all his passion, yes, but to just tell you that members are going to be so benefited. And now we move to a small clipping and a set of bullet points. Now nobody is going to read implementation guides in future. I think this is going to be the future of the profession in terms of using resources.
Yes, definitely, ma'am. That's what we are also hopeful. And with your words, of course, I'm sure more and more members will surely download and start using it. So I take the panel discussion forward. While I'll pose a question to both of you, I mean, specifically to one, but then the other is open to give views on the same. If you want to add something, please feel free. So I start with you, Bhavani ma'am.
But do you want to time the answers to the questions so that you cover all the questions, which I think is very important for a consummate program closure? So maybe 2 minutes per answer. And then if we have time, you can mark the questions where you want more things, then we can do it towards the end.
I think there is enough time, Priya. Sufficient time. Yes. We are well on time.
Yeah. So, ma'am, we start with why do we need to determine materiality? What are the underlying factors?
Yeah, I'd like to draw reference to what Aditya spoke. And to just give you a recap, it is to evaluate the effect of identified misstatements in an audit and of any uncorrected misstatements which remain to be addressed. So in terms of factors, there are two important underlying factors, two branches, I would say. One is auditors' understanding of the possible risk of material misstatement. And secondly, the main factor which affects materiality is the economic decision of the user. So when we take the possibility of the risk of material misstatements, there could be, as we spoke in our opening remarks, it could be inherent factors such as those relating to industry, company, management, stage of control, and overall control environment, the three A's of management, the attitudes, actions, and the various general computer controls, the strength of their checks and balances in their system, the effectiveness of automated controls, and in terms of the detection factors, the internal controls over financial reporting, the quality of evidence which the management produces, and the extent of misstatements we have seen in the audits. And to give you a direct reference to the tool, it would relate largely at the time of planning and risk assessment to the 27 factors which are listed out in the tool which was presented by Ruchika. In terms of users, there are various stakeholders who are the business users of financial statements, as we are all aware. They could be interested as shareholders in the equity, as debt instrument providers on the debt and on the debt equity ratio, and as public shareholders on the entire ethical conduct of business and a lot of business responsibility in reporting in addition to profits. So the focus would be either on profits or shareholders' funds or assets. Again, this is very clearly laid down in the tool in terms of the factors affecting the benchmarks. If this materiality is not addressed properly, the immediate impact would be, in addition to the impact on the financial statements and the auditor's report, it would affect the economic decision of the user in terms of their business decisions, whether to invest, sell, hold. And that has a larger impact than what we as accountants would want to justify either in the audit report or in the financials, whichever side we are. So therefore, materiality is so critical to influence the economic decision of the user, and that is what we as Aditya Lakshman Rekha, as powerful as the Lakshman Rekha, which still stays today from the epic in everybody's mind.
Yeah. Yeah, it's really important. Aditya sir, to you, what is performance materiality? Does it have any bearing on samples selected by the auditor?
So when we look at the materiality level, based on the various factors, we would have determined, for example, 10 as the materiality level. And I would not wait till all the errors accumulate and come to the level of 10. I would keep a lesser threshold, maybe 7 or 8 to that level, and keep watching how much of the audit that I've covered and how many errors that have crept in. So this performance materiality is that level 8, which is an amount less than the materiality level for the financial statement as a whole, but to reduce it to an appropriately low level and probability that the aggregate of the uncorrected and undetected mistakes typically exceeds the materiality for the financial statement. So it is more like I'm having a haircut for the overall materiality. So this has a direct bearing on sample size relationship, inverse relationship. Since a greatly reduced level of performance materiality will call for a larger sample size in order to reduce the risk of accepting a sample when the associated population actually contains a material misstatements. So it's very important to figure out what is your acceptable level and determine the sample size accordingly. If you keep the materiality too low, then yes, your sample size will also increase. And if you have it other way around, the ratio will change. So according to me, these two have perfect relationship, and you also have to ensure that you don't end up having a large size of samples, which will become impractical for the member to actually do the vouching, verification, and evaluate the results. So that is also very important factor.
So, sir, if I just add on, you said if we calculate the materiality at 10, so if I say my performance materiality is 90%, then I have it 9. So then how do you say that you go to the sample? Now with my performance, like I have taken my engagement materiality to be 10, now performance is 9. So what is this difference we are talking about in terms of materiality and performance?
So I'm just giving some sort of a headroom for that. If at all there are any errors that will come up, it will be covered in this particular space or particular gap. Otherwise, I will be end up having all the errors that I need to evaluate at the end to see whether it is materially misstatement. For me, this is something like a danger level, I would say.
Okay.
So the moment I come to that level, I will start relooking at the materiality calculations, and I will try to see whether anything that needs to be changed here.
Right, sir. Right. Thank you.
Just to add to what Aditya had explained, these are all in relation to the quantitative factors. Over and above this, for account balances and for disclosures, there are qualitative factors for which we should also have headroom. See, there are two ways of approaching. We can say that these things are qualitative factors which are considered separately, and therefore I'm not going to aggregate it with this, or you can have enough headroom for qualitative factors and then discount your materiality to that extent, depending on our judgment of what could be qualitative. Because whenever we move to a mathematical model, we forget the qualitative aspect, and there are, especially in terms of disclosures, there are qualitative aspects which members should bear in mind. Thanks.
Thank you. Thanks. So, ma'am, we have also seen in the sheet that we are calculating a trivial threshold. What is that? What exactly do we mean by that?
Okay. The purpose of an audit is to examine and determine that financial statements are free from misstatements. When we talk about material misstatements, of course, and therefore what is not clearly material and what is very insignificant is what we mean by trivial, the true English explanation of the word trivial. Any amount which is trivial and too small in its nature and would not impact the determination of any of our decisions for the audit scope or for the financial statements logically is what should go under what is trivial, and they can be scoped out of the audit. There are actually two instances where these are the trivial threshold is relevant. One is to eliminate the account balances which are below this amount from carrying out any audit work. Okay, you could say these account balances, considering qualitative factors, of course, these are below trivial threshold and therefore no audit work has been carried out. The important thing is you need to document that. And then the trivial threshold also helps us not to aggregate errors below the clearly trivial threshold as an amount, as an absolute amount, to the sheet which you saw on evaluation of errors under SA 450. So if there is an error which is clearly under the trivial threshold, then you need not take it for aggregation of errors in relation to materiality, provided there aren't too many of these, which if aggregated would defeat the purpose. That's logical. So therefore, these are the aspects where this trivial threshold gives you a bit of breather in terms of how you would determine your work and carry out the audit procedures.
Yeah, but then we have to see them in totality also, in aggregate also. Right.
Yeah.
Thank you. Aditya sir, what should be the factors affecting the benchmarks on which materiality is determined?
There's no one answer to this because it depends on the nature of the company, their objectives. So I cannot have the same parameters to be used for, say, not-profit organizations to a profit-making organization to a public sector company, right? Even if you look at the tool, we have differentiated different entities. And based on the different entities, the way the benchmarks also will also change. So it could be revenue, it could be total assets, it could be PBT, it could be net profit after tax, total expenses. It could be any of these factors. A combination of these would also have to be looked into. Now, typically auditors usually use the profit as the benchmark for the profit-making client, or loss if it is a loss-making client. If so, then they may also have to look at the revenues and the assets as a benchmark. For non-profit entities, typically where the revenue keeps fluctuating, it is better to look at the expenses. So there are different factors that needs to be considered. Say, for example, for startup entities where they may not have enough revenue at all in the early stages, then you may have to look at the expenditure, which is more relevant, because they are burning cash at that point of time. Or if it is a capital intensive industry or a capital intensive company, then we may also have to look at the assets rather than, or rather in combination of assets and revenue. It's a combination of all these factors that needs to be considered, and there is no one fit size for all the calculations for materiality.
So the type of engagement.
It's type one, and again within the type of engagement, it could vary year on year. We don't know. It depends on the life cycle of the business, the regulatory environment, the financial condition, etc.
So if a profit entity is has a fluctuating profit over the 3 years, then what do we do?
I may have to take weighted average, for example. So again, these are all factors like Bhavani madam said, you need to document that. I may take simple average, I may have to take weighted average, but why did I choose to have weights is something that I need to decide.
I can also decide to eliminate some transactions which are extraordinary, which are specific for the year, and take the normalized profit. We could do that. In terms of normalization, it could be elimination of certain transactions, or it could be an extrapolation. Let's take a COVID year wherein the business was very low. Then I can project it to what could be a normal business and take that as a benchmark, which I'm sure many businesses have done even for their budget projections post-COVID year, that is 22-23. And even there, they say the first quarter has been very low. So they take a projection that way. So taking clue from that, we could even use the same technique in normalizing the materiality. And as Aditya said, we need to document it clearly.
So for the benefit of the members, I would say that, in the sheet also, we have given normalized adjusted profit. That is what exactly we want to mean by writing that terminology there. Thank you. Thanks, Iman, for adding it. So Bhavani ma'am, we have been talking about materiality. The audit begins, we document the risk, type of risk, we determine an amount. Now, what is the role of my client in doing this? Does he have any role? Does he ask me for the materiality level which I have? Or is it that he can tell me to reduce it further, increase it further.
Okay. Just to quote the standard, under SA 260 on communication to those charged with governance, Para 15 tells us that we have to communicate the plan scope and the timing of the audit. So typically, the auditor is expected to disclose at least, we have seen it happening in all the listed companies where there are audit committees, the materiality with which the audit was done is disclosed, but at the end when they make a presentation to the audit committee. Para A11 gives us further guidance as to what we need to do to help those charged with governance, help them to understand our audit work, the issues of risks and the concept of materiality so that they can make a request for any additional procedures to be undertaken. So the detailed guidance tells us that you should appraise them at the initial stage of our scope of work. Over there, it is what happens in practices. Some of the people talk about their scope of work and not necessarily about the materiality because the draft financials are not yet ready. So therefore, at that point, using what is the scope of work and what is it we plan to do, the audit committee people come back to say, we'd like you to check this area in a little more detail. So to that extent, they could guidance on Para A16. Care has to be taken while we communicate this materiality, especially when the people, those who are charged with governance, are also part of operating management, or it is a single owner controlled organization, because these procedures then become predictable to the people who are handling the financial systems. And therefore, to what extent we want to disclose, when do we want to disclose, there is still a lot of professional judgment there. But can somebody request for the materiality level to be, increased, therefore the scope is reduced? The chance is not there. The chance is that they may request for some additional work to be done, but that is not necessarily linked to materiality. They can make specific requests like that.
Okay. So ma'am,
Right.
in fact, for the listed companies, as what you said, that we do disclose the materiality at a later stage at the audit committee level. So ma'am, for in these cases, they can of course ask for specific procedures, detailed procedures in specific heads at the beginning also, before knowing what materiality levels we have decided. But there is no while the standard says that we should be, as what you said, when the financials are not ready, we do not give the numbers, we do not tell, we just define the scope of work. So would you
add? Yeah, you can describe the procedures, but not necessarily give very specific details on the procedures. You could say, like, what is listed in the key audit matters, what is the kind of work we are doing. That would be sufficient for the audit committee to understand what is our nature of work. I mean, the clear reference which we have is the way we describe in the key audit matters. That is the extent to which we can disclose. No problem.
Done. So of course, it is not that the materiality level can be modified to reduce our scope of work. That is, of course, does not get into that. Also, when you look at terms of engagement, over there also the auditee does not have a right to request for a reduction in scope. If you look at standard, so it stems from there. Definitely. Aditya sir, can we have the materiality calculated as an average of results of using various benchmarks? Like we discussed, there are different benchmarks. Can we average them out and start using it?
Yeah, the standard only talks about how do you calculate materiality and the factors that needs to be considered, right? And depending on the size of the company and the nature of its business, the audit risks that you evaluate and the scope that is given, etc., you can use multiple benchmarks, which will help to not only look at the materiality at the financial statement level, but also materiality at the assertion level or the account balance level. Yes, you can use multiple benchmarks, but those benchmarks that whatever you have arrived, of course, needs to be documented. But then you should also justify as to why you chose to use a combination of of the averages, or possibly a combination, one for statement of P&L and one for balance sheet.
So what we mean is there is no restriction per se. It is a matter of a professional judgment only. What
To,
about?
to add to what Aditya said, a chosen benchmark is relevant to elements of the financial statements, assets, liabilities, profit, or revenue. And when we look at the objective of determining materiality, it goes back to the economic decision of the users.
Right.
So users are different and have different purposes. That is the stakeholders. It could be equity, debt, it could be any of those
Right.
requirements. And then what would be their attention when they look at the financial statements? Well, for example, if it's a listed entity, profit would be the matter of interest. In an unlisted entity, profit is vulnerable to changes due to management override, high level of estimates, and therefore a more stable benchmark would be revenue. That's why sometimes, the auditor decides to take revenue in a privately owned entity. It's just an example. And then the nature of the entity would also matter in terms of the life cycle in which it is. Whether it's a startup, then it would be capital expenditure would be a relevant benchmark to take up. And then depending on the life cycle of the entity, if it's facing a closure and if it has a threat of a going concern, then the benchmark changes. And then the ownership structure, the way the ownership is structured for the entity would alter the thinking of the user. If it's a wholly owned subsidiary, for instance, it could be the economic user may be interested in the holding company would be interested in what would be the issue. So similarly, if we can think about it when we apply our professional judgment from the user's angle, then we are more or less there in terms of our professional judgment in deciding materiality. Therefore, you cannot, in my opinion, you cannot average out because you don't focus on the economic decision of the user. Unless you are able to document the rationale to say, no, I want to satisfy X, I want to satisfy Y. Those are two different circumstances, but still I should cater to two different users. Many a time it becomes a little tough to justify an averaging of benchmarks. I mean, technically, am I allowed, not allowed? Yes, you can do an average. But the rationale behind is who is going to use these financial statements? That if we are able to think about that, what is an interest of an investor in this, then probably we arrive at the right benchmark. Thank you.
Yeah.
See, making an average of two professional judgments of two different economic users could become difficult. I mean, it is very, very important to justify it clearly when you average out. That's the issue.
Yeah. Ma'am, now once we have calculated the materiality, how do we use it now? So 10 lakhs what we determined. Now, what is it that needs to be done in our audit?
Okay. If you look at the overall audit strategy, okay, under para 10, you determine materiality for the financial statements as a whole. And you also determine materiality for specific account balances, transactions, and disclosures. So materiality is used for the purpose of determining the misstatements for specific procedures. So from that, if we drill deep down into the way practically it is taken, it is used for a quantitative scoping. That is, all account balances, transactions, and disclosures above this materiality or above performance materiality are selected for scoping. So if there are other factors which affect this account balance to be critical for testing, yes, but by and large, materiality and performance materiality are taken as a yardstick to select those account balances for doing our audit work. So it is taken for A, assessing risk, and 2, for doing detailed testing. Okay, for both factors, the materiality plays an important role in deciding what should be scoped in, what should be scoped out. Then applying the impact of this risk and considering the population as a whole, one would decide on the scope for testing. So for instance, if the risk is higher and this is the total population, I would first see whether there are large account balances, which are the ones which have to be focused. Only for a residual population, I would look at the risk and then decide how much of samples do I want to select. Let's take a simple example. If there are debtors, and there are, in the debtors, there is an intercompany, receivables. So the intercompany receivables would be concentrated and tested for, confirmation of balance in terms of what is the agreement, what are the procedures. That's a straight jacket amount. And for the balance, which is about 40%, you would decide to send out confirmations, right, to request. And then you would look at after date receipts. So for that 40% of the remaining population, you would apply the risk you have determined and then decide how many you want to select for detailed testing to look at the confirmations to see whether they have reconciled, whether confirmations have gone out. Ideally, the standard requires that you should send out confirmations for all account balances, but at least you need to determine what to test. If you take sales, for example, for the same intercompany sales, you would eliminate because that would be a specific testing which happens. So you apply the risk on the balance population because the type of risk for an intercompany is different. The type of risk for other regular customers is different. And therefore, for this balance population, you apply the risk factor and then determine how you want to calculate the sample. Higher the risk, you want a higher sample size. Lower the risk, you want a lower sample size. I think because there is the standards don't prescribe a very mathematical model for calculating this, I think we should leave it for the benefit of what it says. You could do a judgmental sample, you could do a random sample. So we should leave it at that for members for now to decide on the relationship of risk and the population figure, and then decide how to do the sampling. That would be a simpler process to adopt.
So it is not just, with this number, I go and start the sample. So what I need to do is I have to perform control testing. I need to do other procedures before I actually go out to the sample.
Okay. The order is this. First, inherent risk.
Right.
What are the procedures which you have done? Then testing of controls and systems. If there are no inherent risks and the control systems are effective, obviously your detection risk, the assurance which goes with the overall audit equation, IA plus CA and D is only a balance. Did you hear me? Detection risk and therefore assurance from detection testing is only a balance. So if there is an account balance with a specific risk, you don't get the comfort under inherent assurance and therefore you test more. Logically, with or without applying the standard, if we know that an account balance has a problem, automatically we will do more work. That is what is codified under the standard, nothing different.
Right.
Okay. And there is the qualitative scoping where materiality doesn't play a role. If an account balance qualifies due to qualitative factors, then that is selected for testing automatically.
Now, any example you can give for the qualitative factor?
Managerial remuneration, calculations of managerial remuneration. Those where the Companies Act requires you to disclose for sure. Disclosures under specific industries, these disclosure figures cannot go wrong. So therefore, when we test disclosure, we may not use a materiality threshold for that. Simple, straight example.
Great example. Thank you. That really helps. Aditya sir, to you, materiality and audit risk are considered throughout the audit. When can the auditor revise these? And who can revise these during the audit?
Right. See, in my view, the auditor is expected to have their ears on the ground. I mean, have a pulse of what is happening in the audit from the team and from their own assessments. And when they hear or see something that there's an event or a circumstance wherein the auditor may feel that, oh, it appears to have been quite different from what we expected it to be, then they may have to relook at the materiality level. Say, for example, we plan for an audit and we fix a materiality level and we do all the control testing and we go on with the substantive procedures. In the course of substantive procedures or the control testing, we feel that there are certain gaps, there are certain deficiencies, the number of errors that we are getting tends to be more than what is expected. Then SA 320 para 12 allows me to go back and relook at my materiality level and reset it to ensure that these errors and these gaps or deficiencies are also taken care of. But for a simple example, like when you're driving a car, you also look at the mirror. So auditing is like that. You keep driving, but also have an eye on the mirror. But then if the auditor concludes that a lower materiality should have been than the higher one already determined, I would advise the auditors to relook at your audit procedures, and it would be appropriate to your performance material situations where you could look at a revision as decision to dispose of the business, changes in the business environment, issues in financial statements, or impact of new IND-AS and its implications. Controls are not performing than what you anticipated, or issues that are arising out of substantive checking. So depending on all these factors, and of course there could be many more factors, the auditor can have a relook at the materiality level. And it goes on till the stage of reporting. It could be revised once, it could be revised twice, but it has to be relooked at the reporting stage to finally conclude whether there is any material misstatement or there is no material misstatement.
Okay, so when we revise it, it's usually the number materiality would go down or it will go up.
So typically, if you keep the materiality level low, I feel the risk is higher.
Yeah.
Right. So it should normally go up. Bhavani madam, can you correct me if I'm wrong?
No. I just want to add, Ruchika, when you will come to a stage whether the materiality is lower or higher is at the end, right? So the question of revising it to a higher level probably would only be when you want to accumulate the misstatements and have a look at it. At that time, you will reconsider materiality even in your scope. But otherwise, having done the work, you will land in a situation where you identify further risks and you'll only want to lower if you want to be safe on your audit scope.
Right.
Theoretically, the upward revision is more of a theory in the practical audit than the downward.
Yeah. Yes.
Okay.
We will keep it to a lower level always.
Yeah. Thanks. Yeah. it's just good to beat the theoretical part at times. Yes. So, ma'am, what is the relationship between materiality and audit risk in deciding the scope of work, which we're just talking about?
Yeah. Just as I said earlier, it is intertwined. It has an impact on the scope of audit and the quality of the financial statements. And as Aditya had elaborated, it's purely an inverse relationship. I think that is sufficient in the interest of time for this answer.
Yeah. Aditya sir, we have been talking about materiality. We've been talking about the risk of material misstatement. So now if we say, what do you think would be 3 key factors that must be considered to understand the entity and its environment for a startup engagement for identifying the risk of material misstatements, specifically with respect to startup engagements? Sir, are you there, sir? Aditya sir? Looks to be some technical. Aditya sir, can you hear us?
Now I can hear you.
Nice. Sir, I just repeat the question which I wanted to pose it to you, sir. What are the 3 key factors that must be considered to understand the entity and its environment for a startup engagement for identifying the risk of material mistakes?
Startup is an entity which is expected to, or rather people expect them to deliver certain out-of-box solutions or innovative products, right? And it definitely comes with a lot of risk. So what we look at when we look at the startup entities, a couple of factors is most of the times the management is new, right? Unless it has been backed by a very senior management. Most of the youngsters who come into the startup entities are new. They may come from different backgrounds, may not be able to appreciate the nuances of financial reporting, but they may be really good at marketing or technology or the operational aspects. So again, one is the aspect of somebody who is coming new into the business. Controls is a very important factor. The company is new, entity is new, the business model is yet to be fixed. So the controls also actually are very fluid, I would say. And sometimes we feel that control should have been more strengthened, and they will not be able to do it on day one because they are yet to figure out how the business needs to be done, how the business model, and therefore this control fixing or the will also take time. Third is they focus more on funding requirements. There could be complex financial instruments that they would have taken, use of technology, and the valuations could also vary depending on from where they are getting funded and how the investor is looking at it. So this is a completely new arena for the auditors also when they do the audit for startups, because the way they do the business, the dynamics of the business, the control environment keeps changing, and you need to keep pace with that. And we cannot expect them to do the way things we want, but audit has to keep pace with the way the accounting and the control environment is. So three factors I would consider is the corporate governance or the management entity level controls, I would say. Second is the transaction level controls, and three, about complex financial instruments that typically they use to raise funds, and of course the technology that they use, which could be relevant for our audit.
So if I just add to it, how will it differ if you go from new engagement? If you take a new engagement in case of a new startup, where the startup was new, but now it's a new engagement for you. So does it differ?
Oh, it does differ because I would take two examples. Say company A, which has been here for very long time and they have established business, and I am doing the audit for the first time. So I have the benefit of there is a well-established business model, the corporate governance and the controls. I just have to take up from where the previous auditor left. And of course, SA 510 guides me as to how I need to do those activities. But if the company is also new, right, and there's no precedence of somebody doing the audit, the first time it has been established and we come in as auditors, then obviously it's a completely new arena. We are literally blind as to how the company would perform and the risk that they would be taking. So yes, the risk assessment for a startup is completely different. That's my view.
It's not that, the risk assessment for both is high in terms of controls, no?
I would say it is high, medium, or low, but it is very different. And when I don't know that particular area, I'm going into uncharted waters, I would rather keep my risk as high because I don't want to take any chance. Again, that's my view.
Yeah.
The other aspect of small entities is the fact is that controls exist, but you will not be able to trace them, and they are more of owner managed controls in which you will not have a different person overseeing it. So these two aspects, see, controls exist. They know the way they control the business, and therefore it's because only they know, and it's not necessarily documented in full. Higher risk lies there. See, that's the reason why we would like to be extra careful in doing more of detection risk identification rather than trying to take comfort under controls.
Right. Ma'am, just where you left, we're talking about controls. What about, a typical organization where today, bigger organizations, most of the controls are IT based. So as an auditor, like I understand audit, I know what procedures, but at times of testing controls, do you think that we need an IT expert to take care of that part?
The use of an IT specialist, I would say, is in three areas.
Mm-hmm.
Give a very short and practical answer. Assessment of the IT environment, which is part of the control environment.
Yes.
We need an IT specialist to work with us to make an assessment of the control environment in which IT is significantly intertwined. Okay. Also, an assessment of the overall IT environment needs to be done by the IT specialist. So it's not only the control environment, the total IT environment. The next aspect is in control. That is as far as the inherent risk and the planning goes. The second is when we want to test controls, testing of the general computer controls, as well as the application controls around key application systems, definitely an IT specialist has to do it. Okay, the audit team can work with them, but by and large, it is the IT specialist who takes the call and says, yes, these systems are working effectively, or there are issues which we want the audit team to address. So that's where an IT specialist gets involved. The third area where an IT specialist gets involved is in helping us do a more effective work on substantive assurance, where complex IT programs are there to calculate, for instance, ECL, expected credit loss, and then various bank automated transactions. These IT specialists help us to do one, to scan through the entire population and help us to get exception reports, which we'll have to address. And the other thing is to run test data on these programs and give us a comfort that the programming logic is working perfectly. So they become part of your team. In short, if there is an IT specialist involvement and it is not done away with at the initial stage, saying that the entity has got very low IT involvement, the audit engagement partners only after the IT partner signs off that the.
Ruchika, am I the only one having a problem on the internet, or?
No.
No, all of us are, Priya.
Ma'am,
would you repeat what you just said? Because
you can even go off the video if it will help. So.
Yeah. Repeat what?
Repeat the last part you were saying, because we couldn't hear you.
Yeah. Okay. Can you hear me now?
Yes.
Okay. The thing is that where the IT specialist role is not dispensed at the earliest stage of planning, saying it's a very low IT environment and the specialist is not required. And therefore, the specialist continues working throughout. The IT specialist has to sign off on all the control systems and the final adequacy of the IT systems before a partner signs off the audit opinion. That is how practically it works. They first clear that the IT controls are in place, or they give us a list of things which they want us to address because the IT controls are weak.
Yes, got it, ma'am. But your voice is still a bit breaking. So,
is it? Can you hear me now?
Yeah, you're very much audible now.
Yeah. Okay.
Ma'am, just the point you left, typically how the audit goes is, we start with an audit, we accept to take a new engagement, or we say we want to continue with that engagement. There also we factor a number of things while taking up this new assignment. So does this information have any bearing on identifying the risk of material misstatements?
Relating to IT?
Relating to IT and general also.
Yes, it has a bearing. Previous engagements do have a bearing, and a continuing engagement also requires an assessment of the control environment in terms of any risks which we need to address because of system changes, because of newer developments which have happened, newer businesses which have come in. So an updation of the IT systems and control systems is very essential on a year-on-year basis.
So, ma'am, typically, suppose if I am auditing X client, if there is no change in the IT system, which I have discussed with the client, so typically I assume the controls to be the same as what they have been last year. Of course, I'll go with my testing later on. But when do we do this testing in case of a new client?
In case of a new client, you would do the testing in the first year in full. And then if there are no changes, probably you can decide to do the testing in a phased manner. But you will have to validate that there are no changes year on year.
No, but when I take a new assignment, I will do it in this year. But when do I do that? At the acceptance level, I have had a discussion with the with the management, with the TCWG about the controls being in place. Of course, I'll do the audit later on after I accept. So typically what I want to understand is at the planning stage, when we typically take an engagement and we start planning, then at the planning stage per se, we decide the testing of controls.
At the planning stage, you decide and test the control environment.
Control environment.
Environment. Yes. Then when you come to the testing of systems and you use the IT specialist to understand the control systems as part of your understanding in the planning exercise. They work with you, they rub shoulders with you and work with you through the whole process. It's not a question of when you use them, they come in, they go out. That doesn't work. They have to be part of your team. Therefore, when there is a control system which has got, let's say, 4 steps, the first step is a manual step. The next, it enters into the automated system. Yes. So then, the work moves from one person to the other in your audit team. That's how it works out.
Yes. So it is not that, we decide at a later stage. It should be a part of the...
If you decide at a later stage to involve the IT, that means you have been doing a lot of work manually, which is actually redundant. See, the whole risk assessment is to do an effective and efficient audit. So one, you're not effective because you have not used the IT specialist at the right time. The second is, you're not efficient because you have wasted time doing everything manually, both ways.
Right. Thanks. Thank you, ma'am. Ma'am, going further in this only, the risk of material misstatements is not only required at the financial statement level, but also at assertion level. So what is the role of the engagement partner for risk assessment at the assertion level?
Okay. To give you, in the interest of time, to give you some practical steps.
Let me just tell you one thing is very simple. It is celebration of IC.
Can I continue?
Yes, ma'am. Yes.
Yeah. To give you specific practical steps on engagement partner's role.
Yeah.
In terms of significant risks, the engagement partner has to sign off that at the account balance, transaction and disclosure level, the testing is adequate and the procedures have been effectively applied to address the specific assertion. So at least for the significant risks, the engagement partner's involvement is a given that cannot be done away with. The second thing is to see whether the type of evidence is collected for these risks have an adherence to the auditing standard on evidence. For instance, normally clients typically come back with their understanding of what a letter of representation is, a be-all and end-all of the whole thing. They will come and say that they would give you a representation for something which has to be validated. And easily, because you can't find any other evidence, we may be saying, yes, you give us this, but we need to make sure that our team collects letters of representation only for matters of completeness. It cannot be for validity of a recording because that is work which we'll have to do and evidence has to support that. So in terms of the quality of evidence, assessing the management's integrity, assessment of the systems and controls from our planning stage, the quality of computer generated information, the supportings which they are giving for evidences, all these have to be finally accepted to the partner's satisfaction. If there are issues on any of these, then the engagement partner has a role to play to step up the professional skepticism and ask for more details. In terms of account balances where substantive procedures alone will not give the required assurance, the engagement partner has to be involved to make sure that there is enough of IT procedures to supplement our assurance on this account balance. In terms of revision of risk assessment for account balances, there again, the auditor has a role to play because the risk originally assessed has been revised. So what is the additional evidence? What is the additional audit work which happens? Then those aspects which have significant audit consideration. Risk of fraud, significant economic and other developments, complexity of transactions, related parties, degree of subjectivity, and those which are outside the normal course of business. So matters of significant audit consideration. They also have to be addressed by the audit partner, engagement partner. These are definite areas where the engagement partner has to be involved at the account balance and assertion level.
Yeah. Thanks, ma'am. Aditya sir, ma'am has been talking about significant risks all this time. So while we say risk, is that all risks are not significant?
No, see, from the standard point of view, if you look at para 4, it talks about an identified and assessed risk of materials misstatement that in the auditor's judgment requires special audit consideration. Only those are significant risks. It could be risk of fraud, whether the risk is relating to significant changes in economics, accounting, or other development, or other changes in the regulatory environment. So the complexity of the transaction that gets involved in it. So all risks are not significant. You need to be very choosy about what could really be, get into that material misstatement. And it is again very subjective. So all risks are not significant risks.
Ruchika, risks identified, significant risks, those risks requiring special audit consideration, 3 levels.
Yeah,
Okay.
so we categorize risk into these 3. Yes.
Broadly.
Yeah.
And the engagement partner's involvement definitely in the latter 2 are critical.
Right.
If you take a peer review, for instance, if these risks are not overseen and signed off, it would be a kind of a compliance issue as far as the requirements of quality standards go.
Right.
Yeah.
Ma'am, we do rely on internal audit reports. In case we have an internal audit department, we do rely on their reports in, making our judgment about the systems they have in place. So can it be that we can completely ignore this testing if we feel that, there are no adverse reports which have come in? Because of, the practicality, we have short timelines, we feel there's nothing wrong which is going there. So why should I personally focus, though I'd planned a certain part that way?
Okay. Wonderful question. A decision to say that I will not focus after planning is by itself a big risk as far as the audit goes. Most of the time in peer reviews and in international practice reviews, the issue is something has been planned but not carried through for the entire audit. People have not matched and linked through. This is a common issue which comes up. So the question is, using the work of another auditor, when you look at that, ideally, the use of internal auditors and getting comfort from their work is an accepted procedure internationally. People use this, and there is a way of carrying out that work. But when it comes to our requirements, it is still not there yet. So giving you a background of what needs to be done. First of all, their competency, integrity, and independence and expertise has to be individually assessed by a statutory auditor. That is a process which we'll have to go through, just using the work of another auditor standards.
Right.
And then the adequacy of their work to suit the standards on audit in terms of compliance of the level of testing and the documentation is an issue which needs to be addressed. Unless they are trained in the auditing standards and they are willing to comply with the level of documentation which you will have to pre-share, is another challenge which happens. See, IA should have planned their work with inputs from us. Then their work in risk assessment and controls should be in accordance with 315 at a minimum. Testing should be in accordance with 330, and experts on the IT system should have been involved. Very often, this should be a hand-in-hand work which works throughout the year, and that is not the way this is normally planned in our scenarios. And the work papers from internal auditors, ideally in the international scenario, is taken as part of the audit file. So that their work and their testing, we outsource in a planned manner, specific testing to them, And those work papers form part of the clients come back on the cost and say, when our internal auditors are doing so much of work, why don't you take comfort from that? And therefore, the standards are matched. And if the auditor is satisfied, that is how the scoping is done. Whereas ours is, although we comment on the adequacy of scope on the internal audit, yet we do our work as if we are doing an audit ab initio. So that is what happens in our scenario. We normally look at the scope of work and contribute our thoughts on an increased scope or whatever we want them to do as part of the audit committee requirement. But the assessment of work done and the inclusion of work papers is still a long way to go.
Thank you. That's really helpful. Aditya sir, just going by this, can the auditors use the results of inquiries with internal audit function to modify the NT, the nature, timing, and extent of audit procedure to be performed for risk assessment?
Continue with what Bhavani Madam just spoke about. First, it is the statutory auditor who should evaluate the role of the internal auditor, their competencies, the scope of work that they are doing, the kind of expertise that they have. SA 610 also mentions that it would be useful to agree with the internal auditors the timing of such work, coverage, sample selection methodology, documentation, review and report procedures, and also materiality for the financial statements as a whole or for a particular class of transactions, etc. Depending on the judgment of the auditor and their conclusion on reliance on the work of internal auditor, yes, the audit procedures could be tweaked, but subject to these conditions, which could result in possible impact how the risk assessment is being or will be carried out. Yes, you have the benefit of the work of the internal auditor, but ultimately, when it comes to risk assessment, when it comes to conclusion, it is your own responsibility. So ultimately, it's the responsibility of the engagement partner as to how they would work around it. You may get certain comfort level, but you cannot say that I've completely relied upon the internal audit and I go with what they're doing.
Right. Just a last question to you, ma'am. We have been talking about risk assessment, materiality, but we do everything, but which does not come in the documentation. The file doesn't show what we have done. So what is it that, what are the considerations which must be kept in mind while documenting this? Because at times it becomes really subjective. How you want to document, what is it sufficient? Is it comes as an independent, file? If I review, I get what I did. So what are the factors which you would tell us for audit documentation with respect to these aspects?
Okay. As far as audit documentation goes, my suggestion is follow the last paragraph on documentation of every auditing standard. It lays out very clearly what is the documentation required.
Yes.
So we cannot fall short of any clause or subclause from the audit documentation which is given in all the standards. To assist small business, we came out with an implementation guide and we also revised the guide. It is still available. That guide is good enough because it takes care of all the documentation requirements which are there. In terms of what to document, how to document, the entire methodology requires that you document then and there. Very often, there are 2-3 things which happen. We carry out the audit work with all sincerity, but we don't document then and there. And to the natural functioning of the brain, the memory is lost 1 week, 10 days, 15 days. Then you document in a manner wherein what you remember only. The second thing is document the reasoning in the flow it occurs. Do not say that I will document according to the end position. That is a confusion which we have normally in our professional work. You would have taken certain stands, then you would have got satisfied, and then you would come to a conclusion. What happens if you do a post-mortem documentation? You document according to the final conclusion, and somewhere the thread of where you started remains in the audit file despite all sanity checks. So therefore, the documentation has to flow with the day-to-day work. If we would get into a regime to document work on a day-to-day basis, let's say 4 to 5 is only documentation time, then the audit work and the audit papers are complete. in short, because of the paucity of time, I would try to close with these
No,
three messages on this question.
That's really helpful. Yes, the standard, every standard last para talks about audit documentation, which we should follow in letter and spirit. And as what you said, we should do it on a daily basis rather than waiting till the assembly of files and then we start putting papers together, started documenting. Yeah.
And all implementation guides have got templates, documentation, checklists. So we'll have to have all those in place and document them. That is more than enough. And much more documentation than what is required many a time.
Thank you. Thank you, ma'am. With this, I would just hand over to the convener and the deputy convener for proposing a formal vote of thanks to the speakers.
Yeah, thanks, Ruchika. Thanks, Bhavani ma'am and Aditya ji. That was a wonderful interactive panel discussion, I would say. Very well moderated and the responses were very helpful. I would now request Sri Priya ji to kindly sum up the whole session and also to propose a formal vote of thanks. Over to you, Sri Priya ji.
Before Sri Priya, you start on behalf of Aditya and me, thanks a lot for this opportunity. And Priya, you had said in the initial remarks that I am one of the senior role models. You know where I derive from my energy from? When I interact with members and especially women members as enthusiastic as you. It's always a pleasure to be amongst our members and then try to impart what little we have learned or what are the troubles which we have gone through to share it with everybody. That's a great motivator. Yes, Priya. Mute.
Thank you so much, Bhavani ma'am and Aditya for being here today, and thanks Ruchika and thanks Chairman. So I think what we really did in this program was we understood the basics of why you'd have to do this materiality assessment at all. So how does it kind of manifest itself in an audit context? Then we had Ruchika actually explaining the template to us. The template also has certain words which are printed in it. So you must typically read the words, the steps, and then go to the template, and it becomes self-explanatory. The third thing that we said was this template is pretty comprehensive, but you'd want to hybridize this template. That's where your intelligence and your judgment goes. So there is no really single thumb rule because you can apply judgment and tweak this template whichever way you want. And finally, the perception of risk and materiality is a matter of professional judgment. So how you decide on it would vary, but provides for a standard. Then we had Ruchika who actually showed us how this template works and how you can alter. So the most important thing about this template is that the judgment parts are alterable. So the rest of the focus is like, for example, she showed us 21% on your risk assessment based on a set of parameters. The 21% is actually low according to us, but you might decide for your client that 21 is low or 21 is medium or 21 is high. So that depends entirely on your perception. So you can tweak where the 21 would actually match or where the 50 would match. So for example, let's say it's a very small client, just a simple startup, not even a startup, a husband and wife running an architectural, which you're there. So there you define how you want to materialize or create your materiality or yardsticks for this template. So in that sense, the template is pretty much, not so rigid. And then we walk you through a set of questions in this panel discussion, which will help you to appreciate this whole template better. And of course, we culminated with the last question on documentation, which is the be all and end all in an audit. An audit is a matter of expression of opinion, based on assertions, based on the statements as provided to you, based on performance of certain audit procedures, where you use your materiality and other tools to define what exactly you're going to audit to determine your expression of opinion. In all this, what's most important is that your opinion needs to have a basis. And the basis cannot be just intellectually, driven. It has to be there on paper. And that's exactly what documentation is all about. And I've always said this before, it's a very small coin. It's a very thin coin. You have diligence on one side and you have negligence on the other. And this entire rim that supports you is documentation. So tomorrow, if there is an issue, now which side the coin will fall will basically be on the weight of this rim. So that's about it. So thank you very, very much once again for this really insightful presentation, Bhavani ma'am and Aditya. And what was really nice is that it came with a lot of practical experience. So thank you very much, ma'am. And as it stands, you're super inspiring, and so are you, Aditya. Aditya is also a very prolific speaker on several forums. And for the last 5 years, when I've sort of interacted with him, I've known him to be absolutely passionate. I mean, whatever he does it so well, and it's nice. Thanks so much. And thank you, Chairman, for this great effort.
Yeah, thanks to everybody. Thanks to Ruchika office, and definitely great thanks to all the participants. And wish you all
and this is a recorded program, so we'll put it out. So you may also.
Yeah, yes. And wish you all a very happy Sunday. And I hope all of us have a very nice IPL final today to watch.
Thank you so much.
Thank you.
Bye-bye. Bye-bye. Take care.